Yesterday we started off with an introduction to accounting. We discussed why is it important for us to do accounting? What is accounting all about? You know, we spoke about accounting. We spoke about the skills for you to be able to be good at accounting. And we spoke about the framework where International Accounting Financial Reporting Standards. We spoke about IAS, International Accounting Standards. So we looked at the difference between an IAS statement and an International Financial Reporting standard. We looked at the kind of topics that we're going to be covering in the FAC2601, as well as the topics that we're going to be covering in FAC2602 as well. And we also we spoke a bit about a company. We spoke a bit about the users of the financial statement, because we said that the main reason why we prepare a sort of financial statement is that so that we'll be able to give the users of the financial statement something for them to make informed decisions about, be it a lender, be it a borrower, be it an investor, be it a creditor, or the general public. Everyone needs, some form of information from the company, and everyone's needs are different. Good.
I wanted to ask a question based on the content of this class. Actually, the particular class, this class that we have attended.
Okay, all right. So it's an application of accounting principles. Application of accounting principles. Yeah. So this is what gives us the fundamental for us to be able to prepare financial statements. So before you can prepare financial statement, there are certain fundamental principles that one needs to know before you can actually be able to understand how to prepare a sort of financial statement. So that is what we are going to be discussing today. So accounting concepts, right? So today we're going to be discussing accounting concepts. It is very, very important that you understand the elements that underpins the preparation of a financial statement. If you don't understand what an asset is, if you don't understand what a liability is, if you don't understand what an expense is, or an equity is, you will not be able to prepare financial statements, right? It's very, very important, because every transaction that you see, or every transaction that the company enters into, you're supposed to categorize it into whether it is an asset, whether it's a liability, whether it's equity, whether it's income, and so on. So it is very, very important that these fundamental concepts actually gives you the building blocks for you to know what an asset is, what a liability is, what an expense is. And we're going to do some exercise, for us to be able to get a better understanding. Then also in preparation of financial statement, also there are also certain fundamental. There are also certain fundamental concepts that, in addition to the assets and liabilities and so on, that you also needs to know. So they say these are crucial for ensuring the consistency, comparability, and accuracy in the financial reporting. Good. So fundamental qualitative characteristics of financial statements. Relevance. The information is relevant if it's capable of making a difference to the decision. So they say that whatever, so these are the fundamental qualitative characteristics of financial statements. So financial statements, it must be relevant. If the financial statement is not relevant, then it means that it is not going to be able to affect the decisions of the users of the financial statements. And what do I mean by the relevance of a financial statement? Let's say your year end ends on the 30th of June. Then you only prepare your financial statement in December. The financial statement does not become relevant, right? Because you should be able to make informed a decision earlier. If I wait 6 months before my financial statement are released, then it may not be relevant anymore. It may be too late, right? So the financial statement should be relevant. That is why it is expected that if you are a listed company in the Johannesburg Stock Exchange, you are expected to release your financials. I think within between 3 to 6 months of your year end, your financial statement must be out. Because if you delay, then it defeats the whole purpose of the financial statement. Then the financial statement must be what? Faithful represent. That you must not lie about your financial statement. If an asset is 50,000, you must record 50,000. If income is 100 million, it must be 100 million. You cannot fudge a result. You cannot cook the books. You have to have, that's why we studied about what? Integrity. You have to have integrity. So the financial statement must be faithfully represent what the company has earned or has incurred. So it must be free from error. You mustn't you must try as much as possible that your financial statements are free from material error. It should be neutral. You shouldn't be biased. You must record things as they are, and they must be complete. You should not leave things out. You must not omit certain things from your financial because you think that it's not nice, or when the users see that information, they're not gonna know. It has to be complete. Whatever has happened during the year, you must put it in your financial statement. That is how it works. So we speak about the elements of the financial statements, right? When we talk of the elements of the financial statement, we mean the assets, the liabilities, the equity, the income, and the expenses. Good. Who can tell me the definition of an asset? What is an asset?
How do we explain it?
Try.
An asset could be anything that belongs to the company. It could be fixed asset. It could be current asset. Fixed asset being land, buildings, and then what else? Let me say PPEs. And then current asset would be like cash, debtors.
Okay.
Yes. Debtors, it has another name. Ooh.
Accounts receivable.
Yes, accounts receivable. Yes, I wanted to say that, but it's debtors.
Okay.
Maybe, sir, I think
yes,
Mr. Gordon.
Could be anything that actually belongs to the company and help the company to generate the revenue.
So anything that belongs to the company and helps the companies to make revenue. Okay. So you said anything that is it things that the company own, or it can be things that they have? Must they be legally entitled to that thing? Is it compulsory?
Yes.
Okay.
Yes.
Mr. Gordon.
Yes.
Firstly, there must be legal entitlement. Ne? Secondly, it must be for the aim of benefiting economically from ownership, and it must be controlled by the company. I think it's according to the international reporting standards, if I'm not mistaken.
Okay, all right.
Yeah,
so
it must be controlled.
Okay, all right. So
it must be owned or controlled.
Fully controlled.
I think so.
Yeah, owned or controlled. Yes.
Okay, all right. So the definition of an asset does not say or does not state that the company must legally own it. It says a resource that is controlled. So if you lease it, somebody who leases an asset, you don't have legal entitlement. The lessor has legal entitlement. You don't have it, but it is your asset. So when you are looking at asset, legality does not play a part. So far as you control the asset, you are entitled to put it in your balance sheet as an asset. So like I said,
Mr. Gordon,
yes.
Mr. Gordon, so ownership ownership can be partly. So in that case, we can say that you are partly owning the asset. Take, for instance, Mr. Gordon's, I run an IT company, and then you lease laptops. Ne? And then when I lease the laptop, the mere fact that the laptop is under my possession, right?
Yeah.
Can you conclude that I partly own the laptop, but then legally I can't? I don't know if maybe my question is making sense.
No, it is making sense. I think you just want to for us to explain what does ownership mean, right?
Yes.
So
yes,
So if you say somebody owns something, what is the English definition of ownership? If I own it, does it mean that I can control it, or does it mean that I legally have entitlement to it?
No.
Legally have entitlement.
No.
I think it means that you have.
What? Sorry, sir. Say it again. When you own it.
Okay. When you own something, right?
Yes.
Does ownership means that you just have the asset in your possession, or ownership means that you have legal entitlement to it?
I believe ownership means you have legal entitlement.
Yeah, that's what I think.
Yeah. So when somebody says I own this thing, it means that legally it is yours. You own it. It's yours. When you go to the law court, they will give it to you because you have the sole right to it, right?
Exactly.
You own it.
Exactly.
But the definition of an asset does not state that it's an item that you own. It says that it's a resource that is controlled by you. So it can be owned by somebody else, but so far as it is controlled by you, it is your asset.
Okay. No.
So whenever you read a question, yes.
Yeah. So we only focus. So meaning that when you talk about the asset, the key point is it's controlled by you. Secondly, it's controlled by you for economic benefit. Is that only the two factors that we're gonna look at, or rather play around when we're focusing on assets?
Yes. Yeah.
All right.
So but that is it. So for us, so you must own the asset, and you must be able to control the asset. So once you control it, somebody who controls an asset means that they are able to guard the asset from other people using the asset, right? So that means they are able to get the economic benefit. Because if I control it, it means that I control access, right, from other people using the asset. So that makes me what? That gives me economic benefits. That gives me economic benefits. So when I control it, I can limit other people from using that asset to gain economic benefits. So I'll be the only person gaining the economic benefit. So the definition says an asset is a resource controlled by an entity as a result of a past event and from which future economic benefits will flow to the entity. An asset is a resource controlled by an entity as a result of a past event and from which future economic benefits will flow. So if you have an item and this definition that if it doesn't comply with this definition, it is not an asset. It is not an asset. Does that make sense? Very, very important.
Okay, so I have a question regarding the assets. So say for instance, I have a business and I'm renting bikes, like your Mr. D bikes or Checker 6060 bikes. Okay, so I rent those to owners of businesses. Okay, so in my books, will I have it as inventory or as assets? Because like they're only renting it from me, but at the end of the day, it's still mine. And say they don't pay the rent, I take the bike back. So I just want to know the classification of that. Would that be an asset for me, or will that be my inventory because I'm using it for business purposes in the way of
okay, cool. So what do you think yourself? What do you think? Do you think it's an asset? Like intuitively, do you think it's an asset or it's inventory? And I like this question a lot because now I like the fact that you brought up this question. So when we now finish the framework and we move to the various items on the balance sheet, we look at an inventory. What is an inventory? Under what circumstances can we classify that this thing is an inventory? And under what circumstances can we classify that this is an asset? Right? So according to, so I'm jumping the gun a bit. So according to IS2, which is the framework which governs the understanding of inventory, or how to account for inventory in your balance sheet, it states that inventory is an asset that you purchase to resell, or it is made up of your work in progress. Yeah, so it's either made up of work in progress or item that you produce, finished goods, or item that you purchase to resell, right? So an inventory, you have to sell an inventory, right? In this case, you are just renting the motorbike. You are not selling them, right? So they are not, so it's excluded from inventory. Because if I have an inventory, I must sell it, right? For it to form part of my cost of sale, right? So if I'm not selling it, then it's not inventory. So therefore, then it has to be an asset.
Okay,
right?
So there's still a hand there. Have we covered?
Sorry, can I finish this one before we remove it? Yeah, so it's an asset, and when we go to the IS 16 property, plants and equipment, you understand better why we classify this sort of why something is an asset, right? So an asset, it is defined as something that you hold to produce income or for rental to others or for office use. So these are the three instances where you can classify something as an asset. You see that what? You hold it to produce income, like machinery, like equipment, whatever, or for rental to others, right? You rent it out, right? Or you hold it to for administrative purposes, like when you have furniture and typewriters and computers and those things. So these are the only three instances where you can have what? An asset.
Yeah,
so when you...
Sorry?
Yes. Yeah, no, say it.
If say, so now I have all these bikes, but now I say, okay, you can, it's on a like a rent to own basis. So you can rent it for 18 months and then it's yours. Then you can own it. So what will that be? Because then I'm purchasing something to at the end of the day sell it. So with that then...
Okay, all right. So then you need to be able to classify it at that point in time. So when you rented it out, what is it doing? And then when you sold it, what has happened? So you must be able to classify the transaction depending on what has happened or what has occurred, right? So at the instance where you decided to rent it out, initially was your intention that you were going to rent it out and then later it was going to be sold, or your intention is just to rent it out and then as and when the lessee wants, then they will decide to purchase it. So that must all these factors must be taken into account before you can classify something as an asset or not. And once we get into the various IFRSs or IS, you will be able to go into detail and to tell us exactly what circumstances or under what arrangement that we can classify something as not an asset or an inventory or not an inventory. So sometimes it also depends on the intention, your initial intention. So there's a lot of factors that we have to take into account before we can actually classify something as an asset or not. But under normal circumstances, before we actually go into a deeper understanding of property, plants and equipment, the only instance where you can classify something as an asset is when you rent it out, or it is used for rental purposes, it is used for administrative purposes, or you use it to produce income. I don't know if it makes sense.
Yes, perfect. Thank you so much.
Okay, cool. But we will get into it. We will really once we get it into every framework, we will dip deeper. So by the time you are done with every framework, you will understand exactly what and you'll be able to apply it to your business, or to your scenario, or to your whatever issues that you are having at work. Okay, I think there was another question.
Yeah, I wanted to ask if it does not generate any income, does it fall under assets?
If it doesn't
like
generate,
owning a house. Yeah.
Can you give me an example of something that doesn't generate an income that you are thinking about?
Like having my car, does it fall under assets?
Oh, okay. Very good question.
My house.
Your house, okay. Does it fall under an asset? Okay. Do you prepare? Do you prepare financial statement for yourself?
No. No.
Okay. You don't prepare financial statement for yourself, so you don't say no fundo. Balance sheet as at 31st of December 2001. If you prepare financial statement for yourself, then it will be a different scenario. But so this car, are you using it for private? Is it for private use or for business purposes?
Oh, okay. Understood.
Yeah.
The car is for taking me to work, maybe. And then things like that.
Okay, the car is for taking you to work, right? We are studying about preparing the financial statement for a company, right? That's why I asked that. Unless you are preparing a financial statement for yourself, then it's a different scenario. But we are learning about how to prepare financial statement for a company. So it's the question will be asked: do you have a company, and are you using it for to produce income? If it's not, then it is not an asset. One common example that normally comes in an exam. So they'll ask you whether, as a human being, are you an asset?
No.
Are you an asset to your company?
No.
Why not?
I am.
Oh yes, you mean to the company?
Yes, to the
I,
company.
I am an asset to my company.
Do we record you as an asset? Do we record?
No.
Why don't we record you as an asset?
I believe when they record in part of salaries, and that you are part of the salary.
Yes.
Okay, but salaries is an expense.
With an expense, you are an expense.
Yeah, but then it's also part of you show it on your income statement. So I believe.
Yeah, you show the salaries in your income statement, but remember, an asset goes to a balance sheet. So if you're an asset, you go to your balance sheets, and you as a human being, you are not classified as an asset, are you? Even though you are.
No.
Yeah, I think we have to look at it in accounting manner.
Okay.
Not yes, because I think it is because in most cases, a company or someone who is representing a company would normally say this person is an asset to the company, isn't it?
Yeah.
So it does not necessarily mean they can value that person in terms of figures.
Yes.
That's not what it is. So I think being an asset to the company, it's not, I mean, we are talking of values here.
Okay.
In terms of
figures. Excellent. So the reason why a human being, you are not classified as an asset on your company's balance sheet is because One, before you can classify something as an asset on the balance sheet, remember, right now what we are doing is that we are learning about the definitions of an asset or the elements, definition of an asset, expenses, equity, and whatever, right? Okay, so the standard of the framework that governs the preparation of financial statements says that, one, before you can recognize something as an asset on your balance sheet, first, they must meet the definition of an asset. That's what we have just studied, and a resource controlled by an entity as a result of a past event from which future economic benefit will flow. That's the definition. Secondly, they must pass what is called a recognition criteria test. So the recognition criteria test has two things. One, that it's probable that economic benefit will flow to the entity, which as an employee, yes, you are, as you work, you work hard and the company is able to generate some income from because of your abilities. But you must have a cost that can be measured reliably, right? How do you measure the cost of non-fundo, for example? How do you measure how much it's actually bringing? It's very subjective, right? So because of that, you are excluded from being classified as an asset because it doesn't meet the second recognition criteria, which says that you must have a cost that must be measured reliably, right? Someone may say that you are valued 1 million. Another person might say you are valued 3 million. And it's too subjective. So because of that, we leave a human being out and said we cannot measure you reliably, and therefore you cannot, even though you meet the definition of an asset, but you don't meet the recognition criteria for you to be recognized. So every element must pass two tests: the definition and the recognition criteria. So if you meet the definition, but you don't have a cost which can be measured reliably, we cannot put you in the financial statement.
Oh, okay. I'm sorry to take you back, but with regards to the motorbike example,
yes,
since the motorbikes are an asset, but then they are being rented out, would it be that, okay, let's say for an example, if I was running a hair salon, right?
Yes, yeah.
The shampoo and the conditioner that I use, would that be classified as inventory? But then the bowls that I use to wash people's hair in as assets, since they don't take them anyway, but then the inventory gets used up. Is the main difference the fact that the inventory gets used up, it flows out of the business, or what?
Yeah. So the main reason why you will classify the shampoo and those things as that is that you buy them for resale. In other words, you don't buy to resell, but what happens is that as you buy them, you use them to make your customers hair, and you charge them, right? So it goes into your cost of sales, right? And that is why they are inventory. The bowl, on the other hand, it meets the definition of an asset because what is an item that is what is used to produce income. So it's like a furniture, or it's like an equipment, or that a factory has, right? They are used to produce income. You use them to wash your customers' hair, and it doesn't go away, right? You use it for about 100 customers. Every time the customer comes, you use the same bowl. So you are using it to produce income. You are not. It's not a consumable, right? So it is not an inventory, but rather it's an asset.
Okay.
But rather it's an asset. Good. I like these questions because it tells me that you understand what an asset is. So when it's time for us to start preparing financial statements, we're not going to be found wanting because you guys understand. And that is very, very important. At least now you've been able to tell me differentiate between an expense and or an inventory and an asset, which is very good. Cool. Is there one more question and then we carry on?
I was having a comment about the asset and the inventory because I thought that inventory, it is an asset. It's just that it is a current asset, and there's also property, plant, and equipment. Going back to non-fundo, that she says that the using of the car, it depends on what you're using it for.
Okay.
If she's using it to run a business, like for day-to-day, it will be an inventory. But if it is on the showroom, that is for sale, like she's working for a company that is selling car, that car will be fall under property, plant and equipment. And maybe on the whether people can be assets, I think it depends as well. Like you are owning a soccer club, the players there, you can classify them as an asset. Yeah, that's all.
That's all. Okay. So if you're owning a soccer club, the players there, you cannot classify them as an asset. You cannot, because there's no cost which can be measured reliably. Even though you have, there is they sign a contract, right, to say that yeah, okay, like let's use some of the European players, like maybe Zidane or maybe Ronaldo is worth such and such an amount, right, based on their contract. But that contract, according to the standard, is very, very subjective, right? According to the value. So you cannot reliably be able to measure their value. So the word is reliably. Can you reliably be able to put a value to them? And if and because you cannot, the standard says that the human beings,
Socrates, they buy and sell players.
They buy and sell players.
I think there is a reliable of putting value.
Okay, all right. That would be. Players. I think we'll have to take that one offline. But then the other aspect of the inventory, I said, yeah, like I said, okay. So an inventory is a current asset, right? But an inventory is not. So right now we're looking at PP, property, plants and equipment, right? Something. So the definition of saying that property, plants and equipment are assets that are held for rental to others, for to produce income. Right, it's the definition of what a property, plants and equipment. Inventory, on the other hand, of course, you buy the inventory, but of course, but what you resell it, right? So it's not part of your property, plants and equipment. It is an asset, but it is bought to sell, right? You purchase it to sell. So that is an inventory. So whenever you have something that you buy, but eventually you are going to sell, that becomes what? It's a current asset. It's a current it's a current asset. And an inventory is an example of that. It is an asset, but you are going to sell it within what? A period of about a year. So because of that, it is what? It's an asset. But it is also regarded as what, like a consumable, because you are going to consume it within what? A very short space of time. Compare that one to a plant or an equipment which you are going to be using to produce income which will last sometime for 20 years, for 30 years, and so on and so forth. Right. Does that clarify it? So an inventory is an asset, but it's an asset that you're going to consume, right, within a period of a year. And hence an inventory becomes part of what? Your cost of sales. And your cost of sale is what? It's an expense, right? And an asset, you buy, you keep it, and it's reused for a long time. And you depreciate your asset. Okay, cool. So that is basically the definition of an asset.
Hi, sir. Sorry, please can you? Hi, sir.
Yes.
Please can you repeat that?
Okay. So I said inventory is an asset, but you are going to consume the inventory within a period of 1 year, right? So the inventory will end up being what? Part of your cost of sale, which is an expense, right? So it is initially comes in as inventory, a current asset, but within a period of 1 year, you consume it or you sell it, which becomes part of your cost of sale. And then you have property, plants, and equipment, which these are items that you buy into your business, which you are going to use for a long time, sometimes 20 years, 30 years, 40 years, depending on the useful life of that asset, right? Yeah, so inventory is an asset, but it is what? It gets consumed within a period of a year. Does that make sense?
Okay, so Mr. Gordon.
Thank you.
Yes.
Quick question.
Yes.
Yes. How about the inventory of a car dealership? Say, for instance, VW has a certain stock, and amongst that stock of vehicles, there is some that is not sold within a year. As you are saying that inventory should be within a year. What do we classify the vehicles that are now not sold during a year? Period of a year?
Okay. All right. So they are also also inventory. So okay, so we say that inventory is classified as a current asset, and so under normal circumstances, inventory is classified as a current asset. And what is the definition of a current asset? A current asset is an asset that is going to be used up within a period of a year, right? Sometimes what happens is that if you are a manufacturer or you buy and sell an inventory, there could be instances whereby your inventory have not been sold yet, right? Within a period of a year. So you've got, if you're a manufacturer, you've got raw materials, right, which are part of your inventory. You've got work in progress. Maybe you started producing it, but you are not done. It's about 70% done. We call it work in progress. It's also part of inventory. Then we have finished goods, right? So inventory that you have produced that you have not sold, or in this case, your example, it is inventory that you have bought, but you have not sold it yet. So even though you have not sold it and it's going to be sold at a later a year, it is even though it's more than a year, it will still form part of your inventory. Why? Because it doesn't meet the definition of an asset. The only time you'll be able to classify some of your vehicle as an asset is the vehicle that you brought him, that you used to like a shuttle, right? That when people bring their car for service or whatever, you go and drop them. You know, the ones that you are using to produce income, those will form part of your fixed asset. But the ones that you have bought, the cars that you have bought, even if you haven't sold it at the end of the year, they are still part of your inventory. So under normal circumstances, inventory is a current asset, but there could be instances, like an example, like a car dealership, where after a year they have not been sold. It is still part of your inventory, closing inventory.
All right.
Does that make sense?
Yeah, it makes sense.
Okay, cool.
I think if I'm not mistaken, we'll be dealing with this concept on inventory, on the part
yes,
under
we will.
Financial Accounting 2601. Ne?
Yes. No. Yeah. Now, like now, I think it's the first standard that we will tackle. Inventory is the first one. Yeah. Cool.
Lovely.
And then now let's look at a liability. What is a liability? We have looked at an asset. Now, what is a liability?
It's an obligation. It's a company's obligation.
Good. It's a company's obligation. Good. So the standard defines a liability as a present obligation, right? As a result of a past event, and from which future economic benefit will flow out of the entity. So for an asset, the economic benefit was flowing into the entity. For a liability, the economic benefit is flowing out of the entity. So that is a liability. So who can give me an example of a liability? A present obligation, and when you settle it, it's going to result in an outflow of economic benefits. Yes.
Okay. Here's the one that I like the most: a mortgage loan.
A mortgage loan, yes. A mortgage loan is a liability. Why is it? Why is it a liability?
It's a liability because it's when you make a mortgage loan, it's based on a past event which will lead to a future outflow of the business. Meaning that you go to, for example, let me just make it simple. You go to FNB, you take a mortgage loan, right?
Yes.
And then later on, if maybe now FNB says that you're gonna pay us on the 31st of each and every month, meaning that at the latest there will be an outflow of a certain figure that you must pay, which is now going to tick all the green flags of defining a liability.
Good, excellent. I couldn't have put it anymore. So because the loan is a present obligation. What is a present obligation? That you are obliged, right? When you have the loan, you are obliged to pay back, right? Whenever you have any loan, whether it's an overdraft or whatever, you have a present obligation to the lender to pay back, right? And it resulted from a past event. There has to be some form of a transaction or an agreement that you signed, right? And then it will result in what? As you settle it, it will result in what? An outflow of economic benefit. Because why? Because you have to use cash in your company to settle it. You have to use cash in your company to settle it. And because you are using cash from your company to settle the loan, it becomes what? A liability. Becomes a liability. All right. So so someone has given us an example of a liability like a mortgage loan, right? Good. Cool. And then something like what? A warranty. Is warranty a liability? Can someone just warranty? Is that a liability? After this, we'll just carry on with the next element. Is a warranty a liability?
No, it's not a liability.
Why not?
Because it will not lead to any future outflow in the business. But then, yes, it does tick a few boxes of recognizing a liability, because it is an obligation. You are obliging yourself that you are warranting somebody that you are ascertaining them that a certain thing must be satisfying to a certain extent after their consumption. But now it doesn't lead to any outflow of the business in terms of economically measuring the outflow. There won't be any money going out of the business from guaranteeing or putting a guarantee on a certain service or good.
Are you sure it will not lead to an outflow of economy? Because if I settle the liability, or if I make good that liability, it will end up in me using resources from my company to meet that obligation. Let's say I've sold you a car, and the car is faulty, right? When you bring the car to me, and you have a warranty on the car, so you bring the car to me, I'll have to use things from my company to solve the problem.
Yes.
So in that case, would that not be outflow of economic benefits going out of my company?
But then I think that is subjective. The fact that there will be an outflow can be a little bit subjective. I don't know if maybe I'm on the right.
Okay. All right. Cool. All right. Let's continue. It's something for you to think about. That is the beauty of accounting. Once you can argue your case out, you can classify something. When the auditors come, you tell them, okay, this and this and this and this, it applies, and therefore I can. They will say, okay. So far as you can argue your case, you can classify it as whatever. What is
a warrant is a liability.
It's a liability. Okay. All right. We will get there. When we get to IS 37, provisions, continuing liability, and we will discuss that. What is an income? So an income, according to the definition, is increase in an asset or a decrease in liability that result in an increase in equity, other than relating to contribution from equity or from holders of equity claims. This is quite a mouthful. So it's an increase in asset. So a liability, an income comes about when my asset increases. So for example, if my account receivable increases, right? Account receivable is an asset, that's a debtor. My income also increases, right? That is what it's saying. So it's an increase in an asset or a decrease in liability. So if I have my liability decreasing, right, then it also lead to an income. Does everyone understand this? So for example, what if I can give an instance whereby an income will an asset would increase for it to lead to an income? What would be an example? I've mentioned one, accounts receivable. So when my account receivable increases, which is an asset, my income also increases. What else? What are some of the instances where an asset will increase to lead to an income?
Capital.
Capital. What do you mean? Okay, so if I buy something, right? If I sell something, right? I sell it for cash. So let's say I'm a buyer, I'm selling. So I'm a seller, I'm selling. When I sell for cash, my asset has increased, right? Cash has increased. At the same time, I've received an income, right? So that's what it means by an increase in an asset, right? Or let's say that I go and I do buy and selling, and then one time when I went to buy, the seller gave me a settlement discount, right? That settlement discount is an asset, right? And that has also led to an income. So an income is always, there could be only two main instances where you can have an income. It's either an asset has increased or a liability has decreased. A liability. So for example, if in our mortgage loan example, right? Now FNB tells me that, you know what, for this month, don't pay me anything. Like you have a payment, a holiday. So instead of paying your liability, you didn't pay. The bank gave you like a payment holiday. That payment holiday is what? It's an income. It's an income. Does everyone understand this? The reason why I'm taking my time to explain this is that this is it. If you understand this, there is no financial statement that you'll not be able to prepare. There is no journal entry that you'll not be able to pass. Many people fail because they don't understand, right? And you need only these 5 things for you to be able to prepare financial statement. If I have a transaction, is this an asset? Or if it's not an asset, is it a liability? If it's not a liability, is it an income? If it's not an income, is it expense or is it equity? If I can classify all transactions into these 5 categories, there shouldn't be any reason why I shouldn't be able to prepare financial statements. That's why I'm taking my time. It doesn't mean that all the lectures are going to be slow, but this is so crucial because it's the fundamental of everything. So it is so important that you must understand it. The other topics from here, we're going to go quick, but this is so important because otherwise, every other transaction that we see, you will not be able to do it. You tell me now, some guys are going to say, oh no, this is expense. Someone is going to say, no, this is an asset. Someone is going to know this equity. You know, but once you understand it, it actually helps you. Good. So an example of an example of income is what? An example of income, you have what? Rental income, right? You have revenue. You have what? Your asset has appreciated. For example, maybe you own some property. Last year your property was worth 200,000. This year it is worth 300,000. That gain, right, is an income. Why is it income? Because it meets the definition. It's an increase in asset. Remember, your asset was 200,000. Now it is worth 300,000. Your asset has increased, and because your asset has increased, you have received an income. You understand? So every time an asset increases or a liability decreases, there's an income. Does everyone understand this? Any question?
Mr. Gordon?
Yes.
Yes. And I think this question is very important. So
okay.
When we now, as you are saying that assets are going to increase, the income increases the asset while expense decreases the asset. So does this mean now that in terms of accounting for income, we will put income on the debit side of the asset, and then we will put expense on the credit side of the
asset? Come again.
Okay, it's fine. I'm saying now that in Solas we conclude that income increase asset on the income will increase the asset, right?
No. An asset increase will result in an income, not the other way around. An asset increase will result in an income.
Yeah. Okay, an asset increase will result in an income.
Yes.
And then the decrease in an asset will result in
a decrease in a liability. A decrease in a liability will also leads to income. So whenever you have a transaction where your asset has increased, know that there's income there. Whenever you have a transaction where your liability has decreased, know that there's income there.
Okay, so but can I ask something? And I think this one will save me for the rest of the module. Now, when we are doing the journal entries and the general ledger.
Yes.
When we are doing the general ledger, our asset will increase on the debit side.
Yes.
And then decrease on the credit side.
Yes.
Our liability will increase on the credit side.
Yes.
And decrease on the debit side.
Yes.
Then now our equity will increase on the credit side.
Yes.
And then decrease on the debit side.
Yes.
Our income will now increase on the debit side.
No.
Or
on the credit
will
side.
Increase or on the credit side is the opposite of the equity. Eh?
Yes. Yes.
Okay, and then now our expense is the one that will increase on the debit side.
Yes.
All right. No, thanks.
Good. Okay, cool. So everyone understands income. Then what is an expense? It says it's the opposite of income, right? It says a decrease in an asset or an increase in liability that results in equity. So that results in a decrease in equity. Remember, the definition of an income says that it results in an increase in equity. But for the expense, it results in a decrease in equity, right? So an expense is what? An example of an expense is what? Like what? Stationery is an expense, right? Why? Because why do you think stationery is an expense?
Because we are using it.
Because you are using
we
it,
don't
yes.
use it to generate income.
Yeah, because you are using it. And the definition tells you it's a decrease in asset. So whenever you use something or whenever your asset, when you use stationery, you have decreased your asset, right? So that makes it what? An expense. Or an increase in liability. So let's say you were paying FNB, the mortgage loan that you went to get, you were paying FNB 10,000 rand a month. Now the interest rate went up. Now you are paying FNB 15,000 rand a month. The fact that your liability has now increased, right, from 10,000 to what? To 15,000. So because of that, what you have you have an increase in expense because your interest has increased. Does this make sense, guys? This is so crucial. That is why I'm taking my time and I'm trying to get a lot of questions from you guys, because if you don't understand this is it. You will not be able to classify a transaction. So it's very, very important. So whatever question you have, ask me before we move on. Now we can go fast. Any question you have about the elements, please ask. Yes.
Gordon?
Yes, please.
There's interview saying Kamukelo and Subonelo in that order, please.
Okay, interview saying, please start. Ask.
Hi everyone.
Hello.
Yeah, I just first wanted to apologize for turning on the mic. I had a quick auditing class.
Oh, that's fine.
So yes, sorry, it was an accident. But then overall, I do understand the elements, so I'm good.
Okay, cool. All right. Please ask your question. Yeah, Kamukelo.
Gordon.
Yes.
Based on the accrued income, the accrued income only comes into our financial statement if it falls in that financial year that we are dealing with.
Yes. Yes. That is the only time. Yeah, that is accrued income. So yeah, but I don't want to jump the gun because we will look at all that. But what is accrued income? Actually, in fact, don't let me go. What is accrued income? What do you understand by accrued income?
Accrued income.
Yes.
I think
it's the amount of money that we are going to receive.
It's the amount of money
that we have to receive.
Okay.
It's money and during the financial.
Okay, so basically, accrued
the amount
income
of money that we are going to receive.
The amount of money that we are going to receive. So we have earned it, but we haven't received it yet, right?
Yeah, we are going to.
We are going to receive. Okay, so it's income that we are going to receive. So we have earned the income, but we are going to receive it later. That's accrued income. It's fine. You understand, guys? Ask me the question. I am standing here, and I know the reason why I'm here. I'm on this slide. This is it. Ask me what don't you understand about an asset? What don't you understand about a liability? What don't you understand about income or expense? Will you be able to recognize an expense? Yes.
Yes, sir. So sorry to cut you there. I wanted to just go back to what you said about a personal loan, an increase in the maybe if there was an interest rate hike,
yes,
and then an increase in the monthly payment.
Yes.
Now on the income statement, you can't really show the mortgage loan on the expenses, can you? Can it be fall under expenses once you've taken the cost of sales and you go down below to expenses? Can you put a monthly repayment of a personal loan there?
A personal loan. I mean, that means that is your own loan.
No, I'm just saying a loan.
A loan, okay.
We were talking about a mortgage loan or I don't know. Maybe you can clarify that for me because I'm just responding to what you said. Thanks.
Yeah, in this case, the mortgage loan we are talking about is the loan for the company. So maybe the company has gotten a mortgage loan for its factory, for example. Yeah, but it's not your own. It's not your own mortgage loan for your house. Does that make sense?
So would a business loan then, would a business loan fall under expenses as an expense in terms of monthly payments?
Yes.
My understanding is that it goes into the balance sheet. I'm not too sure if I'm mistaken there. You can clarify that for me.
Okay, all right. So when an expense is, so in this case, right, you had a mortgage loan for your factory, for example, right, and then the prime rate increases. Instead of paying 10,000, you ended up paying 15,000, right? So now it means that your interest expense has increased, right? The interest expense that has increased, it is an expense. So it goes into your income statement as an expense under operating expenses, right? That is what happens.
I'm following. Okay, so what you're saying is the interest paid falls under expenses, and then the actual repayment goes into the balance sheet.
Yes. Yeah.
Okay, thanks so much.
Yeah. So we have remember your loan sits on the balance sheet, right? Because a loan is what? It's a liability. Assets and liabilities and equity goes into your balance sheet, and your loan is a liability. So your loan sits on the balance sheet, right? But the interest on the loan is actually an expense, which must sit on the income statement, right? So whenever you pay an interest, it must affect your income statement. But when you reduce your loan through maybe you got some bonus and you decide to reduce the capital of the loan itself, then that must affect your balance sheet. Does that make sense?
Yes, it does. Thank you.
Okay. All right. Cool. Guys.
Pardon?
Yes.
We still have Sibonello and Ivan, and the next time Joseph must raise the hand, please. You mustn't jump the line.
Okay. All right.
So this was Sibonello. Sorry, Sibonello just finished.
Okay, so when it just finished. Okay, cool. All right. So then the next question is very, very important. If you don't get anything, at least you're able to understand this for this lecture, half of your problems in accounting are solved. Yes. Any other question? Why is cost of sale an expense? And now you are not asking. I'm going to ask my own question. Why is cost of sale an expense?
Can I give it a try?
Yes, please.
I think it can be regarded as an expense because let's say maybe we were to buy a goods that are far from our company, and then they need to be transported, so we will need to pay that carriage on goods, I think.
Okay. So does the carriage on the goods make it an expense? Is that the reason why a cost of sale is an expense?
Mr. Goron?
Yes.
Yes, can I help out the fellow student?
Please.
I think
please do.
the carriage of inventory, it will be added on cost of sales. But now it's irrelevant in terms of proving if the cost of sale is an expense. So in simple terms, right, we say that a cost of sales is an expense because one, it increases an asset. It has an impact of decreasing an asset. One of the assets which is going to decrease is our balance in the bank, right?
Okay.
The basic one, yeah. Because now if we are buying laptops and me and you we are collaborating on an IT company, a minus will be under our bank account, right?
Okay. So are you saying are you saying that the reason why cost of sale is an expense is because we are using money to pay for the inventory?
Yes, to pay for the inventory.
Okay. Remember, I'm also asking you this question, and from the feedback that I get from your answers, then I know the level at which I must go, whether I must just carry on or I must go deeper, or people are fine. Okay, cool. The definition of an expense says what? Yes.
No, I really don't think cost of sale can be regarded as an expense.
You don't think cost of sale is an expense?
Yes, I really don't think so.
You don't think so? Okay. Why?
Yeah.
Why?
Because now cost of sales, in a way, it's an amount of money that we used to buy a particular thing that can be converted into cash in return to us, and that can make maybe profit for the company. So I don't think it can be regarded as
But
an
we are
expense.
buying, it's an expense.
Okay, but the definition of an expense says that a decrease in an asset. If I have got an inventory and I have sold the inventory, have I not decreased an asset?
You did.
Yeah, you have. I have inventory, right? I have inventory, whether I produce it or I bought it for resale, and I sell it. When I've sold an asset, it means that my asset has decreased, and because of that, it makes cost of sale to be an
expense.
Yeah, to be an expense.
No,
Okay, let's carry
at
on.
the same time, saying
Yes.
It's decreasing asset and increasing asset at the same time. So remember, the bank is now decreasing and the inventory is now going up.
Exactly. So whenever you sell, right, there are two journal entries that must be passed. The journal entry for the expense part and also the journal entry for the income part. But we'll get there. Don't worry about it. Why is electricity expense or electricity bill an expense? Electricity bill. that I get from ESCOM. Why is it an expense?
Because it is decreasing our income. So we're taking out money out of our bank account in order to pay. That's why it becomes an expense.
No, it is decreasing an asset, not decreasing your income. It's decreasing your asset. Remember, cash is an asset. Cash is not income.
Yeah, sorry. Yeah. It decreases your asset. Yeah. So
yeah, it decreases your asset. Good. Yeah. Good. Okay. What about if I have profit on sale of fixed assets? Why is it an income? Or I must even ask, is it even an income? Profit on sale. What is it? Profit on sale of equipment. What element does it fall under? Is it an asset? Is it an expense? Is it an income? Or is it a liability? Profit on sale of equipment.
I think it's an asset.
It's an income.
Why?
It's an income.
Yeah.
Okay. One person at a time. One person at a time. Tell me what it is and tell me your argument.
It's an income because it's
profit on
assets.
Can I say why is it an asset on my side?
Yeah, please say why it's an asset.
Because
it's an income.
Please, someone let's have one person to answer the question one at a time, please, because we are learning from people's answers. Remember, yes.
I think it is an asset because it's resulting from past event, and then it is a beneficial economic resource at the present situation.
Okay.
So yeah, I think it just produces that economic benefit at this present moment from a past or current event or event.
All right.
I think.
Oh, you think? Okay, cool. So remember, we said that the definition of an asset is a resource.
Can I give another reason?
Another reason for an asset or an income? Are you arguing for an asset or you are arguing for an income?
It is an income because it increases the revenue.
Can I answer this before we move on to an income, please? Yeah. Okay. So we said that an asset is a resource controlled by an entity as a result of a past event, right? So the past event, yeah, of course, I understand. When you went to sell the equipment, there was a past event, there was some form of an arrangement or a transaction, right? And it will result in future economic benefit, yeah, because I sold it and therefore I've got some money from it, right? But is profit on sale, is it a resource? When you talk of a resource, it's something that you can actually something, I wouldn't say tangible, but something that a resource, something you are able to, something physical. No, you see that is why exactly. So that is why profit on sale cannot be an asset, because it meets the future economic benefit part. Yes, it meets the past event part, but the resource part, it doesn't meet it.
Network.
It doesn't meet it. Okay, right. Someone was arguing for income. Why is an income?
Mr. Gordon, can I just say something?
Yes.
Yeah, you say must profit of sale of profit on sale of equipment.
Profit on sale of equipment. Yes.
Yeah.
So I sold my equipment and I got profit.
Profit.
So
now,
I'm asking whether
can I speak?
Yes, speak.
Because now it's going to be an income because it is a sale that was made, so we received money. So it is an income which increases also our asset because of our bank will also increase.
Good. That's it. Everyone understand that. So whenever you have a transaction or you have an element to argue about, apply it to the various elements. Look at it. Is it an asset? Okay, okay. No, it doesn't meet. Is it a liability? Okay, no, it doesn't meet. Is it equity? I mean, we'll come to equity right now. That's the easiest. Then is it income? Then, oh, okay, was there an increase in an asset? Yes, it was, right? Because when I sold it, because I got a profit, that means my cash has increased, and therefore it is what? An increase in an asset. Good. When the value of my property has decreased, what element is it? The value of my property has decreased. The value of my factory property
it's an expense.
Is an expense. Why?
That is an expense.
It's an
Why?
expense.
Can you argue your case?
Sorry, the decrease of a property, it might be of a depreciation. So a depreciation is an expense.
Okay.
I think so.
All right. So, but in this case, it wasn't a depreciation. It is the value. So maybe your where you bought your property, it was a very lucrative area, so it was high. But after 2 years, property prices has gone down in that area, so your property has come down. So it hasn't come down as a result of depreciation. It has come down as a result of the fact that the property price in the area has just generally gone down. What is it?
Okay.
It's
an expense.
Yes?
Yeah, it's an expense.
It's an expense. Okay, so okay.
I think me and Noktula are on the same page. It's an expense because Mr. Gordon's, when we do the accounting entry of asset devaluation, we're going to actually credit that amount that decreased the asset.
Okay.
So it's going to decrease the asset, but then in this case, it's not going to increase the liability, but rather it's going to also have an impact of a decreased equity.
Okay, all right. So I have a list. Yes. Yes.
Mr. Gordon, can I just ask something? You say the value of property it has decreased.
Yes.
Right? And then you ask if it's an expense. I just wanted to find out, because of it is property, it wasn't sold. How does it become an expense when it's something that is not yet sold?
Very, very good question. So, okay. But what is the definition of an expense? It says a decrease in an asset, right? It doesn't say that because there are so many reasons why an asset will decrease. It's not only through sale, right? It's not only through sale. Okay. A property can decrease because it was stolen. A property can decrease because of obsolescence. A property the value of a property can decrease because it is damaged. So all these things, right, will result in a decrease in an asset. And therefore all these things are all expenses. If I write down an inventory, maybe I am an inventory manager, I inspect my inventory. So on one inspection, I realize that some of my inventory has damaged. The car that is sitting at the warehouse, the window is broken, which has caused the value of the car to decrease. That is an expense, because I have to write down the value of the car from 1 million to 700,000. That difference of 300,000 is an expense. Do you understand? So what I'm trying to say is that it's not, you don't only decrease an asset through sale. It can be through theft. It can be through obsolescence. It can be through depreciation. It can be through whatever. Right. Cool.
So, Mr.
All right. Yes.
So does it mean that it doesn't matter because of when you say the value decreased? So it means if you are going to sell it anytime, it's going to be an expense at the end, because of, like you say, the vehicle is stolen, so it's no longer there. So at the end of the day, at the end of the accounting period, it is an expense because it has decreased your assets.
Yes. Okay. Then we have an equity. So an equity says it's a residual interest in the asset of a liability. So basically,
Gordon.
Yes.
Gordon,
Yes.
We had a hand from Shweshwe, Tavising, and Felicia.
Okay, please, in
Can
that
you
order,
please give
ask
them
me
chance?
quickly and let's move on. But this is the most important slide of all your accounting career. So I'm happy that we are standing here. Okay, please ask your question.
I wanted to ask, can I explain it as to where the expenses are? So if the value decreases of the car, is the money that we will have to take out to fix maybe the car?
Yes.
Explain why it's an expense. That's money you will have to reinvest in your equipment.
Yes. You can say it. You can put it that way. You can.
Okay, thank you.
Yeah. So an equity is what? Is the residual interest in an asset of an entity after deducting liabilities. So remember the accounting equation. Asset minus liabilities equals what? Your owner's equity. Owner's equity is the value of that is attributable to the owners of the company, right? So whenever you see a balance sheet, you see the owner's equity. That owner's equity is telling you that if the company is liquidated and you sell off all your assets, right, to get some money, and you use the money to settle all your liabilities, whatever is left is your owner's equity. Remember, if you have a company and your company is liquidated, right, what happens is that you sell off all your assets, right, and you use the money to settle all your liabilities. Whatever money that is left is your owner's equity. So whenever you see a company and you want to value the company, the starting point of you to know how much the company is worth is the owner's equity, right? Because why is that the case? Because if I sell all your assets and I settle all your liabilities, whatever money that is left, right, is actually the value of the company. That is it. So if you want to look at the value of a company, go for their balance sheet and look at the value of their owner's equity. It tells you how much the company is worth, approximately. So the owner's equity is basically what? The money that will be given to the owner after all assets have been sold and all liabilities have been settled. Does this make sense?
Yes.
Good. So yeah. So that is yes.
There's a hand up from Refilwe.
Refilwe, ask me.
It's a Refilwe. Oh, okay.
Good evening, sir.
Good evening.
I raised my hand back there because we're still on the property value, the decrease in the property value, but you passed that. So I'm not sure if I'm allowed to go back there.
Yeah, you can. Please do.
Okay, I just wanted clarity on that one. You said the decrease in the property value is an expense.
Yeah.
But now I don't understand because we are talking about the property value. So I'm not sure the property value, that word itself, I'm confused. Why is it an expense? Because it's a property.
Okay, I get you. So I'm not talking about the property value. I'm talking about the decrease in the property value. So that differential. So for example, your property was worth 300,000. Now it is worth 200,000. That difference between the 300,000 and 200,000, that 100,000 difference, it's the expense, not the value of not the 200,000, but it's the difference between the 300 and the 200. That 100,000 is the expense. Do you understand it now?
But now, because I own the property myself, does it really matter if the value drops? If it decreases? Or maybe I'm lost.
No, you're not lost. You're not lost, and I like your question. I like questions like this. Okay, so you are saying that you own the property yourself, right? So if the property has come down, you are asking that why must I put it as an expense. Is that what you're asking?
Yes.
Okay. I like that. I like that question. It's a very good and a very important question. The reason why you have to put it as an expense is that, remember, you are running a company, right? And what does the standard say? The standard says that whatever transaction or whatever event that happens in your as you are operating your company, whatever that has happened or must actually be recorded, right? A decrease in property is a very important event that has happened. Remember, you have said that you on your balance sheet you are telling me that your asset or your property is worth 300,000. But now we actually went to value it and we realized that no, it's not 300,000. It's actually 200,000. It's the same as having an inventory in your balance sheet that is worth 300,000. And now all of a sudden, because of sale, now the inventory that is left is 200,000. What happened to that 100,000? It went to cost of sale. The same way, that property was worth 300 because you put it in your balance sheet as worth 300,000. Now, when we went to value it, it's actually 200,000. That means what you are telling us that is worth, you are not. It's a lie, or it's not a right value. It's not a lie. It's not the right value. So in order to show the users of the financial statement that you're actually reporting the right value, you must decrease your property. And if you decrease the property, where will you take the journal entry? Remember, a journal entry, there has to be a debit and there has to be a credit, right? So because my asset has decreased, I'm going to credit my property with 100,000. Where must the debit go? The debit must go to an income statement as an expense, property devaluation, or property written down. So debit property written down and credit property, so that your books, you are showing a fair representation of how much your property is worth. Does this make sense?
Yes, I understand.
Good, thank you.
Thank you.
Any other question? Yes. No question. Good, cool. So everybody understands all the elements of the financial statement. So when I give you any transaction, you will be able to tell me what the journal entry is, right? That is, if I tell you what to debit and what to credit and all those things. Good, cool. We've spoken about recognition criteria, that even though something meets the definition of an asset, a liability, an income, or an expense, we can only recognize it on the balance sheet if it has a cost. And of course, and it makes sense, right? Something can be an asset, but if it doesn't have a value, what value am I going to record in my balance sheet or my income statement? So if it cannot be reliably measured, I cannot put it in my financial statement. So it can meet the definition of an asset or liability, but if it does not have a value which can be recognized reliably, then I cannot. That is the reason why you, as a human being, you are not put as an asset on your company's balance sheet, because your value cannot be measured reliably. Your value is very subjective. Your value is not the salary that you earn. You are more than that. But who can put a value? Who can value you? Nobody. It's too subjective. So the standard, the conceptual framework says that don't value a human being. Cool. Then very important, accounting is prepared using what is called the accrual basis of accounting, right? And the accrual basis of accounting is saying that the effects of transactions are recorded when they happen and not when cash is paid or cash is received. I'll repeat. The effects of transactions are recorded when they happen and not when cash is received or paid. That means irrespective of whether cash has been paid or cash has been received, it doesn't matter. Once the transaction has occurred, we have to record it. And hence, that's why we have something we call accrued income. So accrued income, we have earned the income, but cash has not been received yet. It doesn't mean that because we haven't received cash, we cannot record the transaction. We have to record it. we have to record it. So we have accrued income, we have accrued expense. So accrued expense is something we have incurred. We have incurred electricity bill of 1,000 rand. But because ESCOM hasn't sent us our electricity bill, does that mean that we mustn't record the expense? No, you have to record it. So you can only go and pay ESCOM when ESCOM sends you your bill or your invoice, and then you go and pay. But even before ESCOM sends me the bill, I can estimate based on last month's amount to say, okay, I have an expense, usually a monthly expense of about 1,500 or 1,000 rand, and therefore I must record that as what? As accrued expense. So the word accrued means it has happened, it has occurred, right? And therefore I must record it. I mustn't wait for only when I receive money, or I mustn't wait only when I receive cash or I pay cash. That's when I record. The same thing happens with debtors, account receivable. So I've sold an inventory, right? I sold it on credit. I haven't received the money yet, but I'm supposed to record the transaction to say what? Debit accounts receivable and credit income, right? I've not received the money, but I must record it. Very, very important. So that's how accounting works. So that is what you use to prepare your income statement and your balance sheet and your statement of change in equity. But when it comes to the cash flow statement, the cash flow statement only considers when cash is paid or cash is received. So the cash flow statement is the easiest of them all, because the cash flow statement, you only put something in your cash flow when you have paid it or you have received it. You understand? So income statement, balance sheet, statement of change in equity works on the accrual basis of accounting, which states that whether cash has been received or paid, I must still record a transaction. But the cash flow statement doesn't work like that. The cash flow statement says that only record it when you have received the cash, and only record it when you have paid cash. So if you want to see how much cash you have in your account or in your company, you look at what? The cash flow statement. Because the cash flow statement is the most faithful. It faithfully represents how much cash you have. It doesn't lie. It will not lie. No assumption have been made. If I've paid it, I record it. If I receive it, I record it in my cash flow statement.
So accrual.
Any questions so far? What I've said are very huge stuff. Any questions so far? Does this make sense? Is that anyone who is wondering, who is not so sure about something? Does something not make sense? I'm prepared to explain. Because today we are dealing with the fundamental of accounting. And all our...
Yeah.
Any questions? Is there something that you don't understand? Okay. And no one has got a question. Does this make sense to everyone? You guys are smart, because I struggle to understand these things. Accrual, what is that? I struggle to understand it. Okay, then the financial statement I also prepared on going. Yes.
Just on to make it much more easier, based on the word accrued. When you see like the word in accounting, when it says accrued, you just have to switch on and say they still have to.
Yes, they still have to.
Yeah.
Yes, they still good. I like that. They still have to. So they still have to require. They still have to pay us, or we still have to receive the money, or we still have to pay the expense. So the word accrued means still have to. Still have to. Yeah.
Mr. Gordon.
Yes, please.
Yes. Did you explain the part of going concern assumption?
I'm now going to do it now. No.
Oh,
Okay. So the going concern assumption is very, very easy. It says that when you are preparing the financial statements, you must assume that the company is going to be in operation for the foreseeable future. So just assume that the company is going to be in operation for the foreseeable future, unless or until you know that the company is about to be liquidated. Then you prepare the financial statement on the liquidation basis. But until then, the financial statements must be prepared on the accrual basis of accounting. Sorry. Until then, you must assume that the entity is going to be that is not going to be. Yes.
Sorry for interruption. There's a hand from Felicia.
Felicia, please ask me.
Yes, I want to know that that is just like if it's not foreseeable, if something happens, like suddenly there's a crash in like the Wall Street crash, you know, if something like that happens, you didn't see it, but now things happen that you don't have the money anymore. Everyone's selling their shares and you're losing all your money, and it's a sudden close in your business. What do you do then?
Okay, so we will the second or the third IAS standard that we're going to be talking about, I think it's called IAS. I think it's IAS 10. It talks about events after the balance sheet. Events after the balance sheet. So when an event has happened, but it is after the balance sheet, but before the financial statements are authorized to be issued, right? That period, whatever has happened, you must account for it in your financial statement. So for example, let's say your year end is at 31st of December, right? And your board of directors are going to approve the financials in March, 31st of March, right? The standard of IAS 10, which is the standard that talks about events after the balance sheet, it says that when you have something like that, like the events you have described, if it happens, you must go back and adjust your financial statements within the time that the financial statement have been approved. Then you must go and actually adjust the financial statement to say that, oh, you know what, guys, we thought we were going to prepare our financial statement on the going concern basis, but now because of sudden crash of the Wall Street and that and our company will no longer be in existence, and therefore all the values that we have in our balance sheet are all the realizable values or the liquidation amount. But if any other event that happens after the 31st of March, you cannot go back and adjust your financial statement. Yeah. So whatever you would think about, there's already a standard that talks about it. Like they've already thought about it, and there's already a standard. And that is why accounting is so interesting. Yesterday we said that accounting makes you, if you compare yourself to someone who did economics and someone who did accounting person knows more. Because not only do you know the theory, but you are involved in the calculations, you know, and deeper understanding of things. Yeah. So I like this question. So anything that happens from the time the end of your financial year to the time that the financials are authorized for issue, whenever a change has happened. So let's say your end of year is 31st December and an earthquake happened, and this earthquake happened in February, right? Your financial statement will be issued in March, and an earthquake has happened which has broken or damaged your warehouse and whatever. You have to go back and reinstate the value of your factory to say that your factory was 100,000, now it is 0 because the factory is gone. The earthquake has crashed the factory. But any event that happened after the financial statement has been authorized for issue, you cannot go back and restate your financial statement. Your financial statement must be prepared. You must assume that your financial statement are prepared under the going concern basis. That is how it is. Does this make sense?
Yes, thank you.
Felicia, does it? Okay, cool.
Yes.
All right. So that is the going concern. Yes.
But then there's also Andrew.
Okay, Andrew, ask me.
Yeah, I couldn't. I think you partially answered the question that I wanted to find out, because my question was merely on the assumption itself to say, would it have a difference if the assumption is on going concern, or perhaps maybe if we liquidating, would it change the result? Or I mean,
Yes,
I think
it will.
partially, yeah, I think partially
Yeah,
you just answered
it
now.
will. So yeah, so if you know even before your year end that, and you've always known that the or a subsidiary or maybe your company is no longer going to be in operation, then you cannot prepare your financial statement based on the going concern assumption. You must prepare your financial statement on the liquidation basis. What is the liquidation basis? The liquidation basis, it's that in your balance sheet and whatever, you actually put down what the amount that you are going to realize for the assets and the amount that you are going to settle the liabilities for. So you go and ask evaluator to say, okay, evaluator, have a property. How much will this property yield if I sell it? He said, even though you have it on your balance sheet as 1 million, if the evaluator tells you that this asset is only worth 1,000, you must put 1,000 there in your balance sheet, because that is how much you are going to get for that asset. You understand? So that's what the liquidation basis is. So basically, the liquidation basis is saying that if I sell my assets now, how much will I realize from it, irrespective of how much your asset was costing, you've been depreciating it, and how much it is. Now you have to have the current value on them. Does that make sense?
Yeah, it does. It does.
Okay.
Thank you.
Cool. All right. So I've got some. Okay. All right. Before I even do this, now let me show you. There are certain rules in account. So these are the two most important things. The first one is knowing an asset, liability, expense, income, and equity, right? Those 5 elements. The second aspect is that you must know what which how must I even put it? Which side will be a debit and which side will be a credit, right? There is no logic to this thing. Like if I say debit expense, there's no logic. You just have to know it. Know it by heart. There's no, you can't tell me that, God, and why is an expense, an increase in an expense a debit, or why is an increase in income a credit? I cannot answer that question. This thing was determined before I was born. Right? So those things you must learn them, right? So the rule number 1 is that an asset increases with a debit balance. Write it somewhere. Sorry, I didn't have. Okay, maybe before I publish my thing, I'll put it in. But of course, tomorrow next week. Yes.
Gordon, before you proceed, well, there's a hand from Zanele.
Okay, Zanele, please ask your question. Yes, Zanele.
Thank you. Sorry. Hi, sir. Thank you. Sorry. I just wanted to add on the techniques that you just shared, because I heard that there's like a few people who are new in this whole accounting thing. So I thought maybe this might help. So what really helps me is a technique called dead click, right? So dead click is a short for you debit expenses, assets, and drawings, and then you credit liabilities, income, and capital. So this will help you identify where an asset increases and which side it decreases as well.
Excellent. Can you just share it again? You said debt is a debt click. Is it DEAD?
DEAD.
Yes.
CLIC.
Okay, so CLIC. Okay, so
the first D it stands for debit. Okay. So it means all this that comes. So you debit the expense, the asset, and drawings. This means that expenses, assets, and drawings increases on the debit side.
Okay,
and
good.
Then you credit the liabilities, income, and capital. This means that liabilities income and capital increases on the debit side, on the credit side. Sorry.
Good. Excellent. Excellent, guys. Yes, that is amazing.
Can ship down in the chats, please, for us?
Yeah, please, can you send it in the chats? People need
I'll
it.
do
It's amazing. Yeah.
Mr. Gordon,
So yeah.
the
Yes.
I and the C, what does it stand for? What does the I and the C stand for?
The I stand for income and the C stand for
capital.
Capital. Yes. I is income and C is capital. So it's CLIC, right? Okay. That click.
Yes.
Good.
Yes, I'll
All
share
right.
it on the chat as well.
Okay, please do. All right. So an asset increases with a debit balance, right? So an asset, an expense, and drawings increases on a debit side, right? What does that mean? It means that if I go and buy equipment, right? Equipment is an asset. My asset has increased. So what does that mean? It means I'm going to debit equipment, right? At the same time, what has decreased? An asset is going to decrease, right? Cash from my company is going to decrease. And if an asset decreases, it's a credit. So whilst one part of my asset has increased, which is equipment, another part of an asset has decreased.
Sorry to disturb, Mr. Gordon. Can you just go back a little bit? Just
Okay.
go back where you, to rule number 1.
Is it the accrual basis?
No, just after you explained the debit, expense, assets, and drawings, and there was something you said.
Okay. So I said that. Okay, so I said that. So rule number 1. So the following elements increases with a debit balance, right? An asset, right? Expense and drawings. So when these items increases, they increase with a debit balance. So what do I mean by that? Like if I go and acquire equipment is an asset because I have brought in an equipment into my company, an equipment or an asset has increased. So because of that, what I must debit the equipment. But whilst when I was bringing in, or when I purchased the equipment, what did I use to settle the supplier? It was cash. So whilst on one hand, one asset was increasing, equipment was increasing, but on the other hand, my cash has to go to decrease because I have to take cash from my company to pay the supplier, right? So you see that as I'm debiting an asset and at the same time I'm crediting another asset. I'm debiting equipment, but I'm crediting cash. So there's a debit to equipment, credit to cash when I purchase an asset, right? An expense. Let's say I incur an expense of stationery. I buy stationery, right? Stationery is an expense. It increases on the debit side. So I debit an expense and an asset has to decrease, right? Because I purchased the stationery with my money from the company. So as I'm increased, as I'm purchasing an expense, right? I'm also what? Decreasing an asset, which has to be what? A credit balance. So when I increase an expense, it's debit, and when I decrease an asset, it is a credit. Then drawings. A drawing is when I'm a shareholder or I'm the owner of a company and I take some money or some resources from my company for my own personal use, right? So maybe I have a company that produces cars. I decide to take one of my car or one of the cars that I produce for personal use. That is a drawing. Or I decide to take some money from the petty cash to go and buy pie. That is a drawing. right? You are withdrawing from the coffers of your company. That drawing is a debit. So I debit drawings. And what goes down is an asset, right? My cash has gone down. So I debit drawings and I credit cash. Why am I debiting drawing? Because the rule says that when drawing increases, I must debit it. That is the rule. There's no explanation to it. And then the rule also says that when an asset decreases, I must credit. Which asset has decreased? My money. Or not my money, the money for the business. So as an owner, you separate yourself from your business, right? So you take a drawing and then you decrease your cash because cash has gone down. You've taken money from your company. So you debit drawings and you credit your cash. Good. Now let's look at the other one is what? A liability, right? A liability, they say it increases with a credit balance. So when I've gone to get a loan from the bank.
Right? Sorry, Corinne, I don't see the slide you're working on.
No, I'm not working on any slide. I'm talking. I'm trying to explain. Yeah, the dead click. I'm trying to explain it.
Mr. Gordon.
Yes.
Just a suggestion. With the tier accounts, I think it's easier when you kind of demonstrate it on in terms of writing.
I'll demonstrate it next week. I've got a whole comprehensive like a diagram. I'll demonstrate it next week. So I'll demonstrate it before I give you these questions, so that everybody will get 100%. So we'll go through these questions in class. Yeah. So once good. Excellent. So what have we learned today? Today we've learned the most important things in accounting. We have learned the elements, which is the assets, the liabilities, the expenses.
Saw it Sunday.
The expenses.
Last you saw it Sunday.
The equity.
You saw it,
right? And income. And we so that we've explained them. And you understand them.
1953.
Guys, can the person please
Please mute.
Yeah. So we've learned the definition of the elements, which is accounting is about the elements: assets, liabilities, expenses, income, and equity. We have learned them. We've done examples of them. We've actually explained it, and now you understand, right? So now what I suggest is that now you can just, whatever comes up in your mind, just think about it and say, okay, will I classify this as an asset and apply it to the definition? And that is how it works. And we've explained it. And I think it's the most important thing, because from now on, we're just going to move very fast, because now you know the elements. So in every transaction, we have to pass a journal entry. And because you know the elements, you know an asset, a liability, an expense, an income, and equity, I expect you to be able to understand the transaction and be able to pass the journal entry. Next week, I will give you a diagrammatic sort of like a diagram as to the debits and the which element increases, and there's the debit side and a credit side. Then we'll practice these examples. Then from there on, they will take a journal. Then we move a journal to a ledger. Then we move a ledger to a trial balance, and a trial balance to financial statement. Once that is done, guys, you understand accounting. You understand. Now the only thing now we need to do is we go into we take inventory. Then we go into details, to really to understand. Because in high school, you were just given inventory and whatever, but you didn't really understand how do you actually account for inventory and all the issues that will happen, right, to make you understand what an inventory is. Then we move to property, plants, and equipment, and we'll do the same. Then we'll move to financial instruments like debtors and creditors and investment. If you have an investment in a company, how do you account for it? Then we move to leases. How do you account for a lease? And the what circumstances can account for a lease? Then we move to what? Revenue, if it's 15. So you guys, you are really going to enjoy this course. So I and it's quite a fast pace, guys. It's very right now. It looks as if we are not moving. I'm slowing down today because this is very, very important. But from here on, we're going to move a bit fast. And every week, we are going to take one standard. And so, guys, I urge you to pre-read before you come to lectures, please, so that when you come, you'll be able to ask a lot of questions that you didn't understand whilst you were reading on your own.